looking here at Chapter 17 related questions. So now we're going to talk a little bit about the sale of your principal residence. And a look at some exclusion that you may be eligible to get part or all of. So the question asks us or mentions Sue, who's a single taxpayer, purchased a principal residence in 2001 for $415,000. In 2005, she paid $18,000 to add a sunroom. This year, she sold the residence for $686,000. Her selling expenses were $5,000. How much gain must Sue recognize on the sale? Right, so the first part I've seen worked a few different ways. You kind of work through it kind of like a stock sale. So, but you're going to get the same answer. First, we're going to see what did she really get, right? So it depends on who's doing it. But it's going to be the $686,000 for sure, right? That's what she gets for selling it. Some people will take this $5,000 and will go ahead and reduce it off of this top line, where it's going to be from the amount realized. And that's going to leave you $681,000 for amount realized. Other people, and this one works out the same, will just take that $5,000 and add it to as a part of your cost basis. Either way, it's going to offset your gain. We do have base, so the original cost was going to be $415,000, and any major, not just replacing a light bulb, not just replacing day-to-day needs, but let's say you did an addition, a sunroom. Any major addition, you can, as long as you save the receipts and documentation, you can add that to your cost basis. So her basis is going to be the combination of the $415,000 and the $18,000, or $433,000. So the first thing we know, here's going to be the gain recognized. The first gain recognized, I should mention. Right, so it had $681,000 minus $433,000. So the gain is going to be $248,000. Okay, so currently what happens is, at this point, you need to meet some requirements, but if you're single, we'll just write them down over here. And if you're single and you've lived in house for 2 of last 5 years, yeah, I say 2 consecutive. So if you live there at least 2 consecutive years out of the last 5 years, you can qualify for an exclusion. And the exclusion is if you're single, once you figure your gain, you can qualify for up to $250,000 of exclusion. If you own a married filing jointly, you get $500,000. Right, so we figured up over here that the gain recognized before looking at any exclusion was $248,000. So up here, she bought it in 2001, is safely way after that, right? She's still living it in 2005, so we don't have any reason to think she's not still living in it, and that she didn't live in it 2 out of 5. So she should qualify for the full exclusion of $250,000. So in this case, her gain is going to be $0 on the return. So you put all of this on a form and basically spell out, here's the gain had we not used an exclusion. Now we are going to use the exclusion, so there is no gain. Now I will point out, don't try to get fancy and get that $2,000 difference back. That's not going to happen. And if you had a loss on the sale of your personal house, you cannot deduct that. Business and rental properties, different. Right, so here's one kind of builds off of that a little bit. It says, Mr. and Mrs. Frazier recognized a $723,000 gain on the sale of a home that had been their principal residence for 29 years, right? So easily met the 2 years. They moved into a rented condominium in Naples, Florida. What are the tax consequences of the sale of Frazier's? Right, so they've done the first part. All of this we did up here, they've kind of started here with the gain recognized. And they say their gain recognized is $723,000. They do meet the requirements for their exclusion. Well, their exclusion is not the whole amount, right? They can exclude up to $500,000 of gain. So the recognized gain that's going to be on their return is going to be the difference, or $223,000, and it is going to be a long-term capital gain because you owned a house easily over 1 year, or it wouldn't even qualify for the 2 out of 5 years. Right? So it's going to be a $223,000 long-term capital gain. And this last one here that we're going to look at on this is going to be, kind of what happens if you don't meet that requirement. So on February the 1st, Alan, a single individual, purchased his first personal residence for $400,000. On July 1st, Alan sold his residence for $460,000 because he accepted a new job in another state. Consequently, Alan only occupied the home for 150 days. How much gain must Alan recognize? Right, so remember, if we, well, let's figure the gain before we look at exclusion. So amount realized, sold it for $460,000, had paid, or the basis we have, is what he paid of $400,000. Right, maybe that's what we should be looking at. Between February 1st and July 1st, it increased by $60,000 from what he paid. So he must have been buying in a good neighborhood, hadn't he, to go up that fast. So that's $60,000, right? That's going to be the gain recognized before exclusion. Right, so remember the rule says two years out of 5. Or in other words, you're going to have, 2 years, there's 365 days in a year, multiplied by 2, you're going to have a total of 730 days to meet this 2-year rule. So he was only there 150 days. One thing is, you need to make sure it doesn't qualify. Well, if you have to move because of accepting a new job, it does qualify. You may need to look at that if it's for something else, but that's usually why people move in that situation. So moving for another job in another state does qualify. So, but he's not going to get that whole exclusion amount, right? He's going to be taking the $250,000 that he would have gotten for being single as his exclusion, and you're going to multiply that by 150 over 730. So how much he had over what the total is. So let's look at that, work through that math here. So we had 150 divided by the 730, and we're going to multiply that by 250. So what? 51,370. Right, so that's his reduced exclusion amount. Right, that's not the answer. That's his reduced exclusion amount. Notice it's like a good CPA question that if we were in a hurry, they're going to provide that to us as a choice. Right, but that's his reduced exclusion amount. So he's going to take the $60,000 before exclusion amount, reduce it by the 51,370. So you can see there, that's going to be $8,630. Right, so if you qualify for a potential, reason, you can get partial of that exclusion, but it has to be, qualify, not just because I decided to move next door. All right, so that's the answer is going to be 8,630. And what we did there, looked at the, we looked at here at the single, got to use the single exclusion for the full amount. Here we got to use the married filing jointly amount for the full amount, but we saw it didn't offset all of the gain. And then you saw here where if you didn't meet the 2-year rule, but it was for a qualifying reason, how you could offset, still get part of the gain excluded.